Welcome back to the deep dive. Today, we're getting into a topic that's absolutely critical. It's what separates businesses that can scale from those that just sort of stay stuck.
We're talking about the foundation, the legal and compliance bedrock you need to build a business in India.
Exactly. We've got this amazing blueprint in front of us, made for Indian entrepreneurs. It covers everything from that very first registration click all the way to landing investor funding.
Right. And our mission today is really to give you the strategic shortcut because the sources are so clear on this. Founders rarely fail because the idea is bad.
No.
They fail because they miss these basic legal steps. An unregistered business. It's just a house of cards, you know.
So we're going to unpack this whole process. We'll start with picking the right legal structure, then look at some government programs that give you an edge, and finish up with how to get your company ready for investors.
Let's do it.
Okay, let's start at the very, very beginning. Step 1, the non-negotiable formal registration. Why is this so important?
We use this analogy a lot, and the source material backs it up. An unregistered business is like building a house on sand. It might look good for a while, but the second you need a loan or have a legal issue or an investor gets interested, that first wave just washes it all away. Registration is the concrete foundation.
Let's get down to the brass tacks. The blueprint lists 7 benefits. What are the ones that should really push a founder to stop delaying this?
Well, they fall into 2 main buckets, really. Protection and opportunity.
Okay, let's start with protection.
On the protection side, once you're registered, you can legally trademark your brand name, your logo. That stops anyone else from cashing in on your hard work. And, just as important, it forces financial discipline.
How so?
You have to keep proper accounts. Which sounds like a headache, but it makes tax time so much easier and gives you a clear view of your own business's health.
Right. And what about the opportunity side, the money?
That's where it gets really compelling. First, trust. A registered business just looks more stable. Customers, suppliers. They're more willing to sign bigger contracts with you.
Sure, that makes sense.
Second, it's the only way to get institutional capital. You can't get angel or VC funding, or even a big bank loan, without a formal legal structure. It's just a non-starter.
And the third?
Government benefits. There's this huge ecosystem of subsidies, schemes, and loans out there, but you can only access them if you're officially on the books.
So if you want money from anyone, investors, banks, the government, you have to be visible and compliant. Okay, that brings us to the first big decision, choosing your vehicle.
Precisely. The options can sound a bit similar, but what you choose now has huge consequences for your future ambitions.
The instinct is probably to go for the easiest one, right?
Always. But that's not always the smartest. The blueprint lays out 5 common structures.
Let's run through them. What about the simple ones first? Sole proprietorship and partnership.
A sole proprietorship is the absolute easiest. It's just one person, perfect for a freelancer or a local shop owner. The key thing here is the business and the owner are one and the same legally. You use your personal PAN card.
Which means your liability is unlimited.
Exactly. If the business goes into debt, they can come after your personal assets. A partnership firm is similar, just with 2 or more people and a formal deed. Still often has that unlimited liability problem, though.
Okay, so now we get into the structures actually built for scaling. Let's start with the LLP, the limited liability partnership.
The LLP is a huge step up. It's great for service businesses like digital agencies or consultancies, and the name says it all, limited liability.
Your personal assets are safe.
They're protected from business debts. And the compliance is a bit easier than a full-blown company. It's a really solid middle ground.
But the sources seem to say, pretty forcefully, that for serious scaling, for investors, you need a private limited company, a PVT Ltd. Why is that specific structure so critical?
That's a great question. Because a founder might think, well, PVT Ltd costs more, there's more paperwork, and they're not wrong.
Right.
But investors aren't investing in what's easy for you. They're investing in stability and their own exit plan. A PVT Ltd has a really strong legal framework for managing shares, for transferring equity.
So it's about how they get their money in and out.
Exactly. They need a clean way to buy a stake and eventually to sell it, maybe in an IPO or an acquisition.
Yeah.
An LLP makes that much, much harder.
So that extra cost and compliance for PVT Ltd is basically the ticket price to get into the big leagues of funding.
It absolutely is. There is one other option, the one-person company, or OPC. It's like a mini PVT Ltd for a single founder, but it has limits on turnover.
Right.
Most people just convert it to a full PVT LTD once they start growing anyway.
Before you move on from this, there's some jargon that hits you on day one. PAN, TAN, DSC, what are these?
Great question. They're your basic corporate ID tools. PAN, the permanent account number, is your business's tax ID.
Yeah.
Simple enough. TAN is the tax deduction and collection account number. You need that if you're hiring people and have to deduct tax from their salaries. TDS.
And the DSC.
The digital signature certificate. This is a big one. It's your secure, legally binding digital key. You use it to sign and file all your official company documents online with the Ministry of Corporate Affairs. You literally cannot register a company without one.
Okay, so we've got the structure, we've got the digital keys. Now let's talk about strategic advantages, not just legal requirements. The blueprint highlights some key government registrations.
Right. We're moving from defense to offense now. And the first one, the most valuable for most businesses, is Udyam registration. This used to be called MSME.
I know it comes with benefits, but what's the one thing it does that can literally help a business survive?
It's the protection against delayed payments. This is huge.
Tell me more.
Under the MSME Act, if you have Udyam registration and a big corporate client doesn't pay you on time, you are legally entitled to compensation at a really high interest rate. A cash flow crunch from a big client paying late is one of the top reasons small businesses fail. Udyam gives you a legal weapon to fight that.
That's a massive operational benefit. What else does it give you?
You get access to MSME loans at better interest rates, you get preference in government tenders, and you can even get subsidies on things like getting a patent or an ISO certification. It just makes everything a bit easier and cheaper.
Okay, next up is the big one. Startup India registration from DPIIT. This sounds like the VIP pass. Who gets it?
This is for the really innovative, tech-driven startups. The bar is high. Your company has to be less than 10 years old, turnover under 100 crores, and this is the key. You need to have an innovative or highly scalable business model.
And if you clear that bar?
The rewards are huge. A 3-year exemption from income tax.
Wow.
An easier process to shut the company down if things don't work out. And direct access to funding support through institutions like FSSAI. It's basically a government stamp of approval that makes investors take you much more seriously.
Okay, and finally, GST registration. What's the trigger for that, and why would you do it even if you're not at that limit?
The mandatory trigger is a turnover above 40 lakh for goods or 20 lakh for services. But you have to register immediately if you sell online or do business across state lines or import and export.
And the strategic reason?
Input tax credit, or ITC. If you're selling to other businesses B2B, they will only want to work with you if you have GST. It's so they can claim a credit on the tax they pay on your goods or services. No GST, no big business clients. Simple as that.
And just quickly, what about FSSAI, Trademark, and IEC?
FSSAI is for any food business. It's tiered based on your size. Trademark, that protects your brand for 10 years. And the IEC, the Import-Export Code, is absolutely non-negotiable if you're moving goods across borders.
That is a serious roadmap. Okay, let's shift gears. You've done all this. You've got your PVT LTD, your UDM, your GST. You're ready to talk to investors. What needs to be perfect before you even think about sending that first email?
This is where the blueprint gets very, very direct. It says, investors don't invest in chaos. They invest in a clean, structured business.
A tight ship.
Exactly. And the due diligence process starts long before your pitch. You have to have your house in order.
What's at the very top of their checklist?
Number 1, the corporate registration. They want to see a PVT LTD. Number 2, a clean cap table.
The capitalization table.
Yes. The document that shows exactly who owns what slice of the company.
Yeah.
If that table is messy, if it's unclear, if there are signs of founder disputes, it's a massive red flag. Investors see a messy cap table and they just see future lawsuits. They'll walk away.
So any chaos in ownership is an immediate deal breaker. What about the numbers? The financials?
Flawless filing history. They will want to see every single GST return, every income tax filing, all your annual filings with the Registrar of Companies, the ROC.
Every single one.
Every single one. They'll ask for 12 to 18 months of clean bank statements, and you better not have mixed your personal expenses in there. And you need your basic accounts ready to go. Your P&L, your balance sheet.
You mentioned operational metrics. Let's dig into one. Unit economics. Why is the relationship between customer acquisition, cost CAC, and lifetime value LTV so important to them?
Because it tells them if your business model actually works. CAC is simple.
Yeah.
How much money do you spend to get one new paying customer?
Right.
LTV is the total profit you expect to make from that customer over their entire time with you. If you spend 100 rupees to get a customer who only ever brings in 80 rupees of profit.
Mm,
Your business is a leaky bucket.
you're just burning cash.
You're burning cash. They want to see an LTV that's way, way higher than the CAC. Ideally, like a 3-to-1 ratio or even better.
Yeah.
It proves the machine works.
Okay, so that preparation is the price of admission. Let's look at the funding landscape itself. The blueprint mapped out 9 different options.
Yeah, we can group them into 3 buckets. The first is internal, or bootstrapping. That's your own savings, money from friends and family. The FFF round.
Friends, family, and fools.
The very same. The great thing here, you keep 100% of your company.
The second bucket is government schemes. These feel really important for more traditional businesses.
Oh, absolutely vital. You've got the Mudra loan, which goes up to 10 lakh rupees with no collateral. Then there's the CGTMSE scheme, which guarantees collateral-free bank loans up to 2 crores. And Stand Up India, which specifically focuses on women and SCST founders.
And then we get to the private market. Angel investors and venture capital, VCs. What's the real difference?
It's all about stage and risk. Angel investors are wealthy individuals who invest their own money at the very earliest stage. Often it's just an idea and a good team. They're taking a huge personal risk.
And VCs.
VCs like Sequoia come in later. They're investing other people's money, institutional money. They need to see proof that your business works, that you have sales. They invest when you're ready to scale, not when you're just starting.
And the other alternatives. Incubators, crowdfunding.
Incubators and accelerators are fantastic. They give you mentorship, a place to work, and usually a small bit of seed funding. Crowdfunding is great for, consumer products. And corporate funding from big players like Reliance or Tata is usually more of a strategic partnership.
Okay, we've mapped the options. Now for the final piece, the 7 steps to actually get the money once you're ready.
Step 1, we've said it a few times, but it's non-negotiable. Register a private limited company.
Step 2, the sales pitch. The pitch deck.
Right. Your deck has to tell a really tight story. Problem, solution, market size, team, and your unique selling proposition, your USP. But the most important part of this whole process is step 3,
Which
show traction.
This isn't about what you say, it's about what you've done. What's real traction to an investor?
It's validated performance. Funding happens when an investor sees your passion and your performance. Traction is getting those first 100 paying customers. It's hitting 1 to 5 lakh in monthly revenue repeatably.
So loyalty matters.
It matters more than anything. An investor would much rather see 100 customers who love you and keep coming back than 10,000 people who signed up for free and disappeared.
You have to prove the machine works. Okay, step 4. Build a strong financial sheet.
This is where you back up the traction with hard numbers. P&L, balance sheet, cash flow. And you have to be able to walk them through your unit economics, proving that LTV is crushing your CAC. If you can't explain your numbers, the meeting is over.
So once that's all polished, step 5 is actually approaching them. Where do you find them?
LinkedIn is surprisingly good. AngelList is another. But honestly, the warmest introductions come through your network. Incubators, accelerators, the Startup India portal. They can all make connections for you.
And then comes the scary part. Step 6, due diligence.
The gauntlet. This is where their lawyers and accountants go through everything with a fine-tooth comb. They check every filing, every contract, your background, everything. Any lie or major mistake you made will come out here, and it will kill the deal.
And only if you survive that do you get to step 7.
The term sheet and valuation, where you finally agree on the money, the equity, board seats, and all the final details.
That is an exhaustive process. There's no faking your way through that. What are the most common mistakes people make along the way? The landmines.
They're almost always structural things. Registering the wrong company type and then realizing you can't raise funds is a big one. Not keeping your accounts clean.
Mm-hmm.
Like filing 0 GST for months when you were making sales. That's a huge red flag in due diligence.
What else?
Not doing a trademark search early on. Imagine building a brand for years and then finding out you have to change the name. And another one is raising money too early at a really low valuation, which means you give away way too much of your company.
So if you could boil this all down to one single piece of advice, what would it be?
Don't chase funding, chase customers. Seriously. Start small, but start legal. Build good systems. Get a good team. If you can get customers to pay you consistently, the investors will stop being a target you have to chase. They'll start chasing you. Just focus on making the machine work.
That's a fantastic takeaway. This whole deep dive has really been a journey. from a digital signature certificate all the way to a term sheet.
And it really highlights that proactive mindset.
Yeah,
Given the focus on having 12 to 18 months of perfect bank statements for due diligence, I want to leave you with one final thought.
go for it.
What specific checklist, what little monthly audit could you create for yourself today to make sure every single financial document you produce for the next year and a half is automatically investor ready, even if you think funding is years away?
Wow.
Because that level of proactive preparation, that's what separates the amateurs from the professionals.
A brilliant challenge to end on. Thank you for joining us on the Deep Dive. We hope this gives you the blueprint you need to build your business on a foundation of concrete, ready for whatever comes next.